No, great. I think we had a great session prior to this, filled with tech, deep tech rather. I hope everybody is well caffeinated now that we've got very interesting set of folks here. We've all seen how the ecosystem has evolved, right? Many founders who've raised money from VCs, family offices, and now, of course, from public markets in the last 3 years. So the idea was to really understand what really goes behind these founders while they are raising, right? And understanding how much to raise, when to raise, and from whom to raise. By that I meant IvyCap, of course. And why don't we start this? And I like everybody to introduce. Why don't you all just give a one-liner of introduction, each of you, and that'd be good.
So, good morning, everyone. I am Abhishek Negi, co-founder of Eggoz. Eggoz is building a national brand of eggs which provides better nutrition with herbal feed. And we're trying to organize this large sector in India by by helping organize the value chain with the help of technology. Thank you.
Good afternoon, everyone. My name is Chirag. I'm founder of GetMyParking. We are in a very boring yet $140 billion industry globally. We provide B2B enterprise vertical SaaS for parking operators in cities to run their operations, using AI at our core now to bring a fundamental change in the operational efficiency in this industry. Very excited to be here.
Hi, hi everyone. I'm Gaurav Singh Kushwaha. I'm founder and CEO of Bluestone. We are India's one of the leading omni-channel jewelry company. We started as an online-only D2C brand. We continue to remain very strong online, and we are heavily tech-driven. Along with D2C, we are also fully vertically integrated. So we are full stack all the way from designing to retailing to manufacturing. Everything is done in-house. So we are full stack D2C and trying to bring about changes in a category which generally is very slow to move.
Good afternoon, everyone. This is Sneh here, founder and CEO at Miko. We built a technology platform centered around a consumer robot as an enabler. This robot acts as an animated personality, a friend and a sibling to engage, educate, and entertain children while assessing and reporting their developmental metrics back to parents. We are currently the fastest growing consumer robotics company in the US, and the vision is to positively impact 100 million homes over the next decade and grow a $1 billion revenue generating profitable AI and robotics company from India for the world. Thank you.
Awesome. I think, Abhishek, let's start with you. You know, you've been building this brand for the last 8 years. And from really explaining about building a brand in this category, building a brand for eggs, to now scaling up all over India. How have the conversations really, matured with investors, right? And at the same time, what are the things now you see when you have those conversations? What is the maturity of the ecosystem in terms of, understanding this category?
Sure. Ashley, so it has been a journey. So for context, when we started Eggoz, none of the founding team had any experience about poultry sector. You can say we knew anda about anda. So the initial phase of our journey was mostly to try to build conviction in the investor's mind about us. And the way to do it was to show, to display via actions. So bulk of our initial journey was spent in doing poultry farming ourselves, running poultry farms and learning the trade, with which we aim to get a right to say, not only in poultry sector but also in at those early round in investor talks which we used to happen. So earlier on it was mostly to explain them about the long-term vision. Another point was also that since, as we know in India, and this we learned from a lot of consumers and also from the fact that this sector is still so underpenetrated, is because it's a very low involvement category. It's not only low involvement with the consumers, but also in the mind of investors. So for investors, a lot of the early journey was spent in educating them about this sector. educating them about the problems, about the supply chain, how does the production happen, how does poultry industry work. So that was, the initial part, and of course, creating conviction. I think beyond that, as we evolved further, the conversations started to shift from storytelling and vision to showing proof, and proof in numbers, proof in traction, proof in brand, retention, and all of these factors. So but I think, as the company has matured, it is more about showing predictability in revenues, in unit economics. They have to be positive. You can show that you are starting to build systems in your company that can scale and support your future growth. So,
No, very nice. I think you've just added one in front of the anda to become the number one in India now, right? Chirag, coming to you, right? You've tried to have a balance between the timing of capital. You've raised capital from institutions and otherwise. How have you actually decided the timing of it, whether it should be a bridge round, whether it should be an institutional round, or it should be, a H&I round? How have you managed that? Because at the same time, you have to focus on the growth, and at the same time, you have to look at the long-term vision.
Yeah, that's a very, very important question for every founder, something which we have to reflect internally and see see your leading indicators. I think that is one of the very, very important parameter here. Understand the quality of your revenue and predictability, as we were discussing. If you see strong NRR, strong growth from your existing cohorts, you at least have an option to evaluate whether you want to do a bridge round or do you want to go for an institutional round. And for example, we recently did a bridge with IvyCap and really grateful for all the support. We are seeing 175% plus NRR, very strong growth within our existing farm, zero churn, very strong LTV CAC ratio. So these are very, very, very important leading indicators which helps us to take a call that it's better to do a quick bridge round now and target a larger institutional round with a higher predictability and a better valuation, lower dilution. So at the end of the day, you have to look at your own internal metrics. If you think you don't need a lot of capital to get to the next revenue milestone in your journey, you are always better off doing a smaller round and then look for a larger round 12 to 18 months later.
Got it. Very interesting. Got it. And sometimes you often wonder, right, how much capital to really take because the dilution is so important at the right time.
Absolutely correct. And you'll have to look at your unit economics there and how much do you want to invest in sales would depend upon your growth trajectory. And also, not everything is internal, macro factors, how the market is, everything will come into play. It's a tricky balance, to say the least.
Got it. Awesome. Gaurav, coming to you. First of all, congratulations for the IPO. I think
Thank you.
very good milestone for you in 2025. And
Thank you, everyone.
Gaurav, you've raised a lot of capital in the past from a lot of different people, right? What made you finally think about going public? Because it's a very big step. Now, things have actually changed for you in terms of how you look at the company, how you present your company. And just before the IPO, what were the thoughts in terms of why go public? How do you solve for capital? How do you solve for expectations of investors now? Because now your investors are just not institutions or family offices. Now it's retail investors also, right? So what did you think during that time and how has it evolved for you?
Sure. I think, yeah, so in terms of fundraising, I've seen almost all the stages. So from seed stage to private equity and then going public. I think one of the key, and so every type of capital has their pros and cons. I think private, the biggest advantage with private capital or early stage capital is that you can do a lot of experimentation. So for as long as you are in that phase where you have an idea or you have to do a lot of experiments, you have not optimized your core. You need to figure out, okay, this should be the product or that should be the product, whether this should be the marketing strategy, that should be the marketing strategy, what should be the channel strategy, should it be, like in our case, should it be manufacturing, not manufacturing, what kind of org structure, etc. So there are lots of there's a big discovery phase in the life of any company, I think, and I think private equity or private capital, venture capital solves for it very beautifully, where there are people who understand, who have been, many of them have done that themselves, who work with such companies all the time, and I think they are all ears for you, and they listen to you. And let's say if you need to do something which you believe is right, even the revenue tanks 50%, it's okay. You can do all the, so I'm saying walk in the jungle kind of a thing, an approach you can take when you are private and so on, and that is the advantage of that. I think. And then there are disadvantages also. So every time you need to do a new round, you have to, it takes some 6 months, 9 months and so on. Another cons of that is that essentially because you are private, your stock is still not a currency. So every time an investor needs exit and people have their own life cycles, etc., you have to actually work on that. So that the whole process of, let's say, raising capital, swapping investors, etc., that takes much longer. So this is on the private side. Now on public side, the pros is that your stock is currency essentially, it's liquid. So you can, if anyone, if, uh, if, if anyone wants out, then they can sell the stock. If anyone is interested, they can come in. If you need to raise capital, that's a 3-week process and so on and so forth. Other sources of capital also, because you become very structured, you become your disclosures, your financials, etc., are in a certain format and so on. So a lot of lenders, etc., also take a lot of comfort from that. So you get easy access to a lot of other cheaper source of capital also. So those are advantages of public markets also. At the same time, I think it's very important to understand the stage of the company. So if you are in that discovery phase, if there are lots of unanswered questions that you want answered, then private is good, private is right. I think once your business becomes predictable, at least the core of it, 80-90% of that, right? You have to always keep that 10-20% of experimentation, etc. You also or you always need to have that in your DNA, that you can, if there's a bright idea, you can experiment on that and maybe you can come up with an opportunity. Like Google, in case of Google, search was there but Android was still spun out of it. In case of Amazon, they were selling books and other things, but then still AWS came out of, right? So that was that 10% experimentation that is still there. But as a public company, 90% of it cannot be an experimentation. You cannot next year be doing something which is radically different from what you were doing last year. Not the core of it, right? I mean, something small goes on and it becomes bigger than the core business, that's fine. So I think having that predictability in your core business is very important. And once you have that, once you are confident of that, then I think it's the right time to go public. There are lots of different other differences also. For example, private equity typically would have a lot higher growth expectations also, and rightly so, because they are also taking a failure risk, right? So if something works, it better works at a much staggeringly big levels. Whereas public market investors are fine with, and they are more comfortable with predictable growth. It need not be 100% or 20% quarter on quarter, 30% quarter on quarter, like we hear very commonly in the privates. But if it's 20% YOY, predictable, that's good enough. So I'm saying there are lots of differences, lots of pros and cons for both, but I think right stage is very important to decide.
I think consistency is more valued.
I would say reasonable consistency in the core business. And I see a lot of us entrepreneurs who have worked, who have thrived on this whole problem solving things. Okay, this problem, that problem, you might find that boring. But then you can still have 10-20% in your company where you're actually looking for next big moonshot. But I think the core has to be there. The core has to run seamlessly. The core has to run like a clockwork.
Fair enough. Talking about consistency and predictability, Sneh, coming to you, you've been in a very long-term game, robotics and consumer play at the same time. You've raised capital from, bunch of investors, whether family offices, institutions, impact funds. What is the right investor profile, right? And how do you kind of add it to your capabilities so that company can grow at the same time, just not looking at the capital, but at the same time ensuring that there's a value add layer which is coming to the table, right? And how has that evolved for you over the last few years?
Company, the initial capital was purely angel capital, then the institutional capital followed, and now we're looking at larger institutions, impact funds, and that kind of different foray. And during the journey entirely, I think within our cap table, we've always ensured that institutional and family offices together participate and so on. And the value add from every set of investor is significantly for different kinds of moments in the journey of the company. When you're building a company in completely new markets where you are evolving over there, at that point of time, institutional support to take big risks and big bets in completely new areas is there. And if you need a certain support, immediate support, timely support, family offices step in for that support immediately without they short circuit the entire process, and they help you immediately and give you the push. Larger impact funds who typically come in, they focus on balanced growth between financial and impact. The balanced growth has to come through and so on. So I think every cap table needs a healthy combination of it. If you go completely skewed towards one, then you regardless of the path, whether you're building a deep tech company or you're building a normal consumer internet company, you will be the pros and cons of each respective will follow. So my recommendation to all entrepreneurs will be that ensure that you have a healthy balance of each type of fund into your cap table so that you get the best of it all and you are able to at the right moment capitalize on the value add from each of these set of investors.
Fair point. Yeah. Abhishek, coming to you, you've very recently raised a private equity background, and now that you're also shaping up eventually for the next few years for IPO, right? How has governance played a role for you, right? And considering that there's a lot of impact happening in your business, how has that evolved for you? And what importance now are you making sure the culture of Eggoz has governance in place, right? So, and why don't you talk a little bit about that?
Sure. So at Eggoz, right from the very beginning, uh, we were clear that with Eggoz we are trying to build a generational company, and to do that, it's not only about solving a problem, building a team, generating revenues. You have to look at it from the point of view of building an institution for the longer run. And to build an institution in the longer run, governance, which stems from very basic traits of transparency, humility, and honesty, became very important for us. So, for us at Eggoz, these traits, which comes to your question, governance, is a very core part of our culture. And how it has evolved, I would say, definitely relative to the stage of the company, the requirements have definitely evolved, be it say following the right financial metrics, looking at the right numbers without any sugarcoating. At Eggoz we say that just display the numbers or the fact as they are, not only to us, management, but also to our investors, to our lenders, to our partners. Display as they are, to the people. And how now we are looking at governance is, in addition to looking at compliances, ESG, and sustainability metrics, I think it becomes very important that as we start to scale up, and since we are working in a sector where we are selling food, and food is, people put it inside their body. They are trusting your brand for their protein needs. They are trusting your brand for the nutritional needs of their child and for their families. So the entire system, internal system of supply chain, quality checks, rigorous rejections, better quality standards, and the right culture to follow through on it becomes really, really important as we scale up. And as we scale up, the stakes are even higher, right? So our point of view on it is how can we create an infrastructure of trust inside Eggoz, and which would be the right systems and processes to institutionalize it. So that
And
is
at
how
the
we look
same
at
time, ensuring alignment with the investors, right?
it. Of
Because
course, yeah.
that's very important fact that now you've got a much healthier board So that's even more important, ensuring everybody is building towards governance.
That's very, very important because as your company starts to mature from, say, a bootstrap company to a private equity venture-backed company, it is evolving into a, for a simple term, it is evolving into a shared company, right? So it is owned by everyone. And when there is shared ownership, it's alignment becomes very, very important, especially at a stakeholder level.
Got it. Talking about alignment, Chirag, coming to you, how have you managed the board alignment, right, over the years? Because it gets a little tricky at some times, right? And it's so important to ensure that everybody is aligned towards the same goal, whether it's employees, customers, suppliers, or for that matter, your board, right? So how have you balanced that out?
Yeah, I think transparency, as Abhishek mentioned, is very, very important. We call, you know, you also have to go back to what your industry is, how long the sales cycle are, how long the deployment cycle are, what are your true modes, what are your weaknesses, being transparent about that. That has been very critical for us. We look at, in our case, we see very, very large lifetime value of customers. It takes a longer sales cycle, longer deployment cycle. But at the flip side of that, which is in our favor, is we build very strong defensibility, very high quality of revenue. All of that investment, these are long-term bets which we are taking in the industry. An alignment of our shareholders, stakeholders, internal team members is very critical. It's not unlike some of the B2C and as I said, we are in a boring industry. And some of these industries, these vertical segments have longer sales cycle but deeper moats, which results into building strong unit economics, fundamental businesses for the long term. Everyone has to be aligned, and that is absolutely a must for us to be able to take long-term bets for our vertical.
Very interesting. Gaurav, coming to you, you spoke about, ensuring there is certain kind of consistency, right, and predictability for that matter. And, you were the first few brands practically in India who adopted technology very early. Now that you've gone public, you have to ensure public investors are happy at the same time. You need to be agile also at the same time. So how are you balancing that out in terms of using the technology, trying new things at the same time, being agile and giving consistent quarter-on-quarter growth so that everybody is happy?
Yeah, so we have very strong seasonality, so it will never be quarter on quarter, but year on year. So yeah. So like I said earlier, I think it was very important for us to kind of stabilize the core business before we go public, and we did that. In fact, in 2019, we took it was a significant year for our company when we decided that online-only approach towards, so it was entirely D2C, but the channel sales channel was only online. So online-only approach is not going to be as strong as what the omni-channel can possibly deliver. And I think first 4-5 stores that we opened, and that also kind of validated that hypothesis. So I'm saying that experimentation that we were doing at that time was at that scale, which was make or break for the company. If it does not work, then the value of the company is suddenly zero. If it works, it can be anything. So I think that kind of experimentation certainly is not something that you do in public markets, and rightfully so. Venture capital is built for that. But at the same time, what we have in our company also, that while the core business over time, what we are also trying to make sure is that it's not that people dependent. It's more like we need to put in processes in place, structures in place, where people are just kind of there to execute what has already been discovered, what has already been laid down in terms of those structures, etc. So I think core business needs to run on those structures. And at the same time, there are those 3 or 4 projects, 3 or 4 ideas that we continue to work on, which generally on the cost side is not too much, but things which kind of naturally emerge as we do our business. Some idea might emerge of, let's say, creating a system that can better handle customer queries specifically for our need. And then beyond that, you can also think that what more can it do and so on and so forth. So I think uh, so a lot of those experimentations, etc., are also something that we create small pods of not more than 3 to 4 people who keep working on these things, who are not accountable for, let's say, the overall P&L or the top line or the core metrics of the company. There's a small budget for that, and they keep on working on that. So I think that is how we are trying to. And me and my co-founder, we both spend considerable time on those also. Since for last 12 years, 13 years, we've been problem solver, right? As the business matures, the number of problems that you have also reduces significantly. So you need something to keep you excited as well. So I think these things help with that as well.
Oh, very interesting. While we are short of time, I'm just going to ask one question to all of you all. One lesson which you would like to share with some of the founders here, right? Which, if you knew back then, it would have made your life easy in terms of fundraising or just raising right or raising it from the right person. If each of you could have, one lesson which you could share.
I think, say, there are many lessons, but I think one I would share is that investor alignment is very important, and almost all of the times it is more important than just valuations. So that would be my input.
Yeah, I'll just
Better valuations are always appreciated.
no, I'll just add +1 to that. It's absolutely don't just run behind valuation. Look for right long-term partner, because it's not a 2-year, 3-year, 4-year journey you are in. You're in a long-term play. So you get right partners, very important.
Got it.
Yeah, so I think one thing that worked very well for me was there are multiple investors, but I think there are 1 or 2 of those with whom you can actually build a much stronger relationship beyond just an investor-founder kind of a relationship, and that kind of helps navigate the situations much better. I've been lucky to have a few such people on the board. I think everyone has their own personalities, traits, and different timings, different expectations, but I think building very close bond with 1 or 2 of the early ones really help. I've seen it in several cases.
Got it. Sneh, if you could respond to that as well.
So I think the mindset should be like a cockroach, sprint when the window opens, and have strong resilience if it shuts, and always be ready to sprint again. Like that mindset is pretty crucial in your journey when you're raising capital.
Got it. No, great. Thanks a lot. Thanks a lot for your time. And I think we're short of time, so we'll close this
Thank you,
panel.
everyone.
Thank you.
Thank you.